Hello everyone and welcome to my channel. In this video we're going to talk about Lucid Motors, trading under the ticker symbol LCID. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. A lot of folks have been eyeing Lucid because for a while it was seen as the underdog, the small Tesla with the potential for a big market cap. People wanted to get in early and ride the wave of growth. Now, back in 2020, during the good times, everyone believed that Lucid was on track on delivering something big, and the stock soared to a record of $55. But of course, we're far from those glory days now. Lucid isn't just seen as a cool EV maker anymore. The whole perspective on the EV sector has shifted ever since, and Lucid is feeling the effect. Looking at the numbers, Lucid's revenue didn't shoot up in the last few quarters of 2023. The supply chain headaches that have been, hunting the EV industry also hasn't really magically disappeared. They're still hanging around. So here's what's going on, or what I think is going on. We definitely need to be a bit cautious about Lucid in the coming year. The financials are showing signs, and with the economy possibly heading into a rough patch, it's wise to approach this with a careful eye. Let's keep an eye on how things unfold for Lucid in the near future. With that being said, here's the technicals. The trading volume of Lucid has recently been around 17 million shares, compared to an average volume of 40 million shares. Over the previous 52-week period, the price fluctuated between $3.62 and $17.81. The volume of shares traded tells us how many shares are being bought and sold at any given point in the market, and if there's enough liquidity to support a trading strategy. If the float is thin, it would be easy to influence the stock price around, but also difficult for an exit. When we compare the current volume against the average volume, there might be the possibility for a trend reversal or breakthrough if the difference is very large. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Lucid is currently around $9.9 billion. As we compare the current price to the historical price fluctuations, the stock is 6% higher than the 1-month low, 19% higher than the 3-month low, and 19% higher than the 52-week low. On the options market, which sometimes may give us a hint about where the stock may head next, the implied volatility is around 85%, compared to a historical volatility of 72%. The put-call volume ratio is currently around 42%. It's normal for most stocks to also have a higher put option volume than what they deserve, since many institutional investors hedge their long positions with put options. The most recent volume of options traded is around 45,000 contracts a day versus the 30-day average volume of 73,000. Regarding the open interest, the most recent volume of open interest has been around 1.7 million contracts, versus the 30-day average of 1.7 million contracts. Regarding the shareholder structure, institutional shareholders own 74% of them, which is quite significant given the scale and history of the company. The biggest shareholders include Vanguard, BlackRock, and Invesco. Usually, it's always good to see some institutional presence when holding a stock long-term because it offers a layer of stability and a token of reliability in the medium to long term. It also means that the market believes that this company will eventually deliver value in the long term, an important factor to consider for investors. I believe that the threshold should be around 25 to 30% of institutional ownership. The current short interest is around 30% of the total float, and 54% of the transactions coming from the dark pools. Usually, if the short interest is above 15% of the total volume, and a significant portion of the shorts come from the dark pools, it may suggest that there are institutional positions taken to short the stock, and that there would be potentials for a. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators, Interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one: the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up the what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. So, with that being said, let's break down the situation with Lucid Motors for your EV portfolio. Including Lucid in your EV investments does make sense considering its role in the broader EV sector. With that being said, don't expect fireworks unless the Gravity SUV hits the scene. If you're looking for rapid profits, Lucid might not be your top pick. But for those playing the long game, looking for a stock to hold on to for a while, Lucid's got its own spot. Just remember to stick it to like a very disciplined approach. It's all about finding the balance between the short-term gains and volatilities and the potential for steady growth over the medium to long run. I would recommend to commit between 3 to 5% of your portfolio in Lucid and to split the allocation in batches of 20% so that you can purchase more over time in case of any retracements.